Hello and welcome back to AusBiz as we get across this Tuesday. I'm Andrew Gagan. Thanks for joining us here on The Global View. Let's take a look at what did happen globally overnight. Stocks edging slightly higher, while US bond yields initially extended gains in response to the downgrade of the US government's sovereign credit rating. Stocks on Wall Street recovering from earlier losses on weakened market sentiment to finish marginally in the positive. Those rate-sensitive tech and growth stocks began the session negatively as the Treasury yields increased. Among the Mag 7, Tesla fell back around 2%. And we can also see movement there. Microsoft, perhaps the pick of the bunch. Novavax shares surged after the company secured a long-awaited US regulatory approval for its COVID-19 vaccine. And Regeneron Pharmaceuticals announced it will buy genomics firm 23andMe for $256 million through a bankruptcy auction. US listed shares, the gold miners, they did gain. That's after tracking a rise there in the bullion price, benefiting from a weaker US dollar. Well, US President Donald Trump's sweeping tax cut bill, which had been stalled for days by Republican infighting over spending cuts, won approval from a key congressional committee. However, the bill still faces opposition and potential change in the full House and Senate. Meanwhile, President Trump said that Russia and Ukraine would begin talks immediately on ending the war after a phone call between Donald Trump and Vladimir Putin. And FOMC member John Williams suggested policymakers may not be ready to lower interest rates before September given the uncertain economic outlook. And fellow member Raphael Bostic said the economy is in a lot of flux. Policy is in flux. There's a lot of uncertainty. I think we'll have to wait 3 to 6 months to start to see where this settles out. And JPMorgan Chase Chief Executive Jamie Dimon has said that markets and central bankers underappreciate the risks created by record US deficits, tariffs and international tensions, saying we have huge deficits, we have what I consider almost complacent central banks. You all think they can manage all this? I don't think they can. Well, the US two-year Treasury yield initially rose to 4.04% but then fell back to 10-year, making similar moves to be around 4.45%. Markets pricing in just a 5% chance the Fed funds rate will be cut at next month's mid-June meeting, but pricing in 4 more cuts in the easing cycle. And the US sovereign credit downgrade has weighed on the US dollar. The dollar index down there around 0.7% and the Aussie trading at 64.6 US cents. And Bitcoin trading at 105,500 US dollars. Oil prices marginally higher on signs of a breakdown in US talks with Iran over its nuclear program. Brent crude futures at $65 a barrel. Copper rose 1.5%. Iron ore down marginally at $100 a tonne. And the gold price firming on safe haven demand following the downgrade of the US government's credit rating. Spot gold 1% higher at $3,230 an ounce. So let's get across those market moves with a focus on the US. Steve Sosnick joining us from Interactive Brokers. Steve, welcome back. So, the US credit downgrade looks as though, well, certainly those equity market traders and investors largely shrugging that off.
Yeah, buy the dip remains supreme, and that's pretty much what we saw today. When I woke up in the morning, futures, S&P futures were down about 77 points. It's about 1.5%. By the time I got out of the shower, they were down 55 points. And then we just sort of kept moving higher and through the open, the regular open, and throughout the day. A lot of it was helped by the fact that bond yields recovered. I don't think we would have had such a dramatic rally if the bond yields were remained at the levels that we saw higher in the day, because we were sort of ahead of 3 major sort of psychological benchmarks: a 4% 2-year note, a 4.5% 10-year note, and a 5% 30-year note, 30-year bond. And we were above all of those levels. But I guess buy the dip applies to bonds too, and so off they went. But it did not apply to the dollar, and that led to the gold price rally that you mentioned.
Steve, you may have just heard that quote from JPMorgan Chief Executive Jamie Dimon. What did you make of that, where he's saying that the central bankers are underappreciating these risks at the moment, that they've been complacent?
I'm not sure that they are. I mean, I think the comments that from the two Fed governors that you mentioned, Williams and Bostic, do recognize the risks involved. Both of them basically implying that there's no that that there's no need to cut rates right now. I'm not sure what Jamie Dimon means by that because I think that what Bostic and Williams were trying to get the point across is they're more concerned about inflation than a declining economy. And that's actually been one of the question marks is with the part if the dual mandate between full employment and stable prices starts to unravel a little bit, which one do they choose? I do think though that what Diamond is saying, another way to interpret it is what I believe is one of the bigger risks is that we can start to unravel the two different parts of the mandate, and that the Fed might be slow to react to a shrinking economy because they're more worried about rising prices. So there's a few ways to read this, but basically, I think the Fed is vigilant, but I also think the market. I do agree with Mr. Diamond in the sense that I think the market way overestimates the powers of the central bank to recuperate a sick economy if we get to that point.
I mentioned also that bill, that big beautiful bill, as Donald Trump calls it, is before Congress at the moment. If that does succeed in getting through, what is the likely reaction? Because is there an anticipation perhaps it's going to have to be altered to some degree?
I think so. I mean, the between it getting originally vetoed in the committee and being approved, basically around midnight last night, was that the members who had been opposed to deficit increases voted present instead of against, which let the ayes have it, so to speak. Um, Remember in our system, it's still got to get through the full House, which mean, and with the very narrow majority, if those five are representative of other representatives, sorry for that weird wording, then that it's got a difficult time passing the House without major negotiation. Then it's got to go to the Senate, and the thresholds in the Senate are higher, and it's a bit difficult. Then you've got to reconcile the two bills. So there's a lot of horse trading that's got to go on. But the bottom line is, essentially, there's all this talk about deficit spending and all these other things that it doesn't appear that this bill addresses that at all and actually has the likelihood of making the budget deficit worse. That's why I was a little surprised to see bonds react as well as they did today. I'm guessing that was more technical buying because the bill as it stands now, would raise the deficit by trillions, despite the promises that this would be budget neutral and that the new administration would be trying to balance the budget rather than expand it. But obviously, the preference seems to be for tax cuts and tax cuts that exceed the spending cuts at this point.
Meanwhile, Steve, you'll get a good read of the US consumer this week when some of the big retailers are reporting. What's expected? Guess also in light of what we heard from Walmart last week.
Well, I mean, Walmart was a fascinating result because the market originally liked it. It wasn't necessarily great, but it was better than feared. And then they made the comments that they were going to have to raise prices to offset the tariffs. The stock sold off, but again, every good dip is a buying opportunity these days. So the stock actually ended up unchanged, and then they got browbeaten by the president, basically saying, "Don't pass on those tariff raises," and they sort of made noises that they won't. I find it impossible. So either they're getting sort of browbeaten, or they're getting their margins cut, or both. It's hard to say. But Home Depot and Lowe's are a bit more discretionary. I mean, I find myself having to go to the hardware store plenty. I just bought some caulk today, but we find ourselves, that they're a bit more tied to the home ownership cycle, and in many cases, a lot of the purchases there, when you're not buying things like caulk or nails or something like that, are more discretionary. They sell a lot of appliances, among other things. So it'll be very interesting to see what trends they're seeing and if there's been sort of front loading of ahead of tariffs, or if there's just sort of a generic fear, because we can't lose sight of the fact that consumer sentiment numbers that came out on Friday were atrocious. They were worse than the already low expectations that were in there. Again, though, every dip being a buying opportunity, the market rallied anyway. But at some point, I do have to worry whether gravity takes hold, and I think Home Depot and Lowe's will tell us whether the consumer is a source of strength or really a bigger source of concern than we've been really pricing into the markets.
So, Steve, in terms of portfolio positioning, you just simply hold tight at the moment?
I'm going to stick to my mantra of don't fight the tape, but insure against it. It's very, very hard to short this market. It's just not working. And I would never advocate someone to just sort of stand in the way of a freight train, which is really kind of what we see. But I think there's enough cracks here that leave us susceptible to negative surprises. And when you have a VIX around 18, which is not quite complacent, but much closer to complacency than fear, I think that's a prudent way to go. We actually are seeing a fair amount of demand for downside puts, despite the low levels of volatility in the marketplace, which tells me that you have a lot of aggressive funds basically going all in on the rally and doing just what I said, buying some insurance against it in case this thing cracks. I don't know what causes it to do that. The momentum is really positive, but as we said, there's certainly enough. There's no shortage of negatives floating around. If you want to say we're climbing a wall of worry, I'll argue maybe we're climbing I won't call it the Everest. Maybe it's the K2 of worry right now, and that's what we seem to be seeing.
Well, enjoy the climb, Steve, and the week ahead. Thanks for joining us from Interactive Brokers.
Thanks, Andrew. Take care.
Let's come back home now, just ahead of the start here on a Tuesday, and looking for a very positive start. In fact, SPY futures up almost 0.9%. Of course, the big event today will be that RBA decision, 2:30 Eastern. Expectations they will cut again, taking the key cash rate down to 3.85%. We'll get right across that live here on AusBiz. Be sure to tune in for that. Stay with us. The open is just around the corner.